RBI has hit the pause button on repo rate hikes, but amidst the ongoing global uncertainty and inflationary pressures, interest rates are unlikely to come down anytime soon. In fact, news reports suggest that after RBI's recent incremental CRR move, deposit rates may actually go up. So, how can you as an investor take advantage of the current interest rate scenario? And are fixed income mutual funds a better way to go than fixed deposits? Giving us important insights in this TOI Wallet Talks episode is Manish Banthia of ICICI Prudential MF. Welcome to the show, Manish. Thank you for taking out time for us. So, Manish, as an expert, where do you see the interest rate scenario headed in the next 12 months?
I think we've seen a period where interest rates have either gone up or gone down. For a long time, we've not seen a period where interest rates have not gone anywhere. They've remained as such. Right. So I think it's a habit for everybody to think that either you are in a rising interest rate scenario or in a falling interest rate scenario. To me, right now, we are in a neutral zone of interest rates, and I don't think interest rates will move too much from where we are, given the fact that both growth and inflation are well positioned at this point of time. So to me, it's the interest rates are about how the growth and inflation. These are two variables which the central bank looks at. For a long period before 2020, what happened was growth was under delivering, and therefore whenever inflation came down, there was a room for central bank to cut interest rates.
Right.
From 2020 onwards, we've seen that growth has started to come up well, and therefore, with the current framework, the Reserve Bank of India is going to look at both growth and inflation, not them. And at this point of time, we think that neither growth is excessive, nor inflation is on a continual basis in the excessive zone. So we think that Reserve Bank of India has to either cut interest rates to stimulate growth, or they have to hike interest rates to arrest inflation. We are in a comfortable zone from that perspective.
Okay, but whenever interest rates are reasonably poised or giving, if you're getting good returns, fixed income is one option that is much talked about. So, from an average investor perspective, what percentage of my portfolio should be allocated to fixed income?
Right. So, I think from a asset allocation perspective, fixed income is something which people should look at this point of time from a more positive point of view. The reason is that we are not in the low interest rate environment anymore. The interest rates are reasonably high for people to choose fixed income as an asset class. Secondly, when I compare the valuation of other asset classes when people can invest in, I think fixed income is reasonably valued against other asset classes.
Right.
Now, there was a change in taxation, on the mutual fund fixed income side, which happened in the month of March. And at that point of time, I had a view that this change of taxation would lead to other asset classes doing fairly well over fixed income. I think that's kind of played out in the last 3 months. And now I think both the assets are more neutral, and people should look at fixed income from a more positive lens, given that it will add, some safety to the portfolio. And at the same time, it will also protect it against market volatilities in some of the other asset classes.
Okay, but Manish, when it comes to fixed income, most people would tend to think of bank fixed deposits or post office savings schemes, even corporate FDs for that matter. So, why should investors look to opt for fixed income mutual funds? That's another option that is available. But vis-a-vis these three, what are the advantages of getting into a fixed income MF?
I think there are a lot of advantages of getting into the mutual fund fixed income segment. I'll start from a basic thing, right? When you invest, in a liquid fund, I think that's the simplest form of investing in fixed income. Liquid funds are 90-day, bucket funds where your money is parked for a small period of time. So you have excess money in your savings account, you can push that into liquid funds. The benefit of mutual fund is that they are market linked. So the return which mutual funds would generate, say a liquid fund would generate, would be close to where the market rates are prevailing. Whereas in case of savings bank account, these interest rates are fixed for a long period of time, or any other traditional instrument. These while they would adjust, but the adjustment is very slow. So one, mutual fund adjustment in terms of returns happens in line with market movements. Right. Secondly, the liquidity aspect of mutual fund is something that I don't think is available anywhere else. you have a T+1 liquidity available at any point of time. So from that perspective as well, if you have excess money you want to park in any savings instrument, I think mutual funds come very handy in terms of the money market segment of the mutual fund.
Right.
Again, when you want to take benefit of market movements, say for example, if interest rates are very high and you want to lock that interest rates, again, mutual fund is a vehicle where you can do it. So for example, if somebody thinks that the 10-year GSEC is very high and in the foreseeable future interest rates are going to go down, instead of doing a 2-year 3-year FD, he can park that money in a long duration mutual fund, right? The third advantage for a mutual fund is that mutual funds are actively managed. And when a fund is actively managed, the ability of the fund to generate an active alpha over similar passive funds or similar passive product is very high. I consider bank FD or a corporate FD as a passive product, right, where what your return is. It's not going to give you a higher or a lower surprise. Whereas if you look at a active mutual fund, it has the ability to generate that extra return over and above what the market YTMs are. Of course, it is subject to market risk, but that ability remains with a mutual fund.
Okay, and finally, Manish, what are the kinds of debt MFs that I can actually look to opt for?
So I think one category which I have liked always is the all season bond fund category. It's under the dynamic debt fund category. The reason I like this product, it's like an evergreen product where investors need not time the market. They need not have a view of whether interest rates are moving up or moving down. Whether you want to invest in a AAA fund or a GSEC fund or a AA fund, the fund has the ability to do all by itself.
Right.
So I like this fund because in this fund, if somebody invests for a very long period of time, he can ride different periods of the debt market, the different periods of interest rate rising, falling, and also from a perspective of generating a higher YTM on his portfolio compared to what a AAA or a sovereign GSEC fund would do. So it's a fund which has advantages of portfolio diversification. From a current market perspective, I think that the short duration is a good product. 1 to 3 year is a good duration to be in. The long duration to me is a tactical play at this point of time. At some point of time when yields go up, as tactically you can buy long duration products, but you will have to sell these products as the short term yield movements are towards the downside. You can't stay invested in long duration products at this point of time. From a investor's perspective, if he has to choose a fund where he can remain invested for some longer period of time, I think the short duration product is a good product category at this juncture. One thing which I would want to add here is, which I started with, is I think asset allocation is very important. And while people like one asset class, I think a portfolio diversification perspective is a better perspective to have from investors' side. And fixed income, fits very well in asset allocation perspective.